Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's Friday, and we're back together again.
Bob, our listeners around the world always have questions for you, so we'll wade straight into those questions. The first one is from our friend Andrew. Andrew says, with collapsing revenues and ballooning national debts, it seems ridiculous that interest rates to lend governments are not above 10% from a credit risk and inflation risk perspective. Does Bob expect interest rates to rise over time, or are the banks who own most of the government debt going to attempt to keep yields low by throwing good money after bad in order to avoid taking huge losses on their bond portfolios for as long as possible?
Yep, Andrew, good question, and it's certainly at the forefront because the central bankers are being, well, highly reckless. Now, in the last 20 years, there was a time when they weren't. So it's the same old, and you've got now extraordinarily collapsing revenues while they're boosting the debt, so it seems out of control. And yeah, interest rates will head up, but you have to distinguish between term. For example, in a contraction, the T-bill rate goes down, and then the Fed follows with its administered rate. But if you're in a very serious contraction, then rates for corporate bonds and municipals, they head up. And now all the old inflationists who learned all their stuff from the 1970s, when the Fed was reckless, and but it was during a period when there was time for inflation to soar and interest rates to soar, which they did. And then you get into a period where the public chooses to speculate in financial assets, stocks and bonds. And this is where we've been for a long time, and it's reaching a climax here now. But the old inflation and gold and silver bugs, they only know the 1970s. They don't know the 1930s, where no matter how hard the Fed tried to push credit out the window, deflation was on. And as a matter of fact, in July 1932, the editorial in the esteemed Barron's newspaper noted that no matter that every anti-deflationary measure taken by the Fed is seen not to work. And that was the case. And so what you have here now is a pattern. You have a decade where you get inflation in commodities. Everybody plays tangible assets. And that last peak were in 2011 and 2008. 2008, crude oil was up to $147. And then you go into a decade or more of inflation in financial assets, stocks and bonds, which we've had. And then once the public burns itself out in stocks and bonds, then those prices head south. And of course, that then becomes a bear market for stocks and a bear market for most corporate bonds as price goes down. And it's not a return of inflation that puts the yields up at the longer end. It's the inability to service debt that then people discover that, there's too much debt, there's not enough economy to service it, and everything from from junk to exceptionally high grade is at risk. So, good question. And the other question was, part of it was that the government would be attempting to keep yields low by throwing good money after bad. They will continue until the window shuts on them. I think on the next full contraction, which seems probable, that the public's going to look at the trillions of dollars that the central banks, Bank of Canada and the Fed, have thrown at the markets, and it's all gone away, all for naught. And I think we can have political uprising to reform excessive government, and also part of that would be to reform excessive central banking. Good question. Thanks, Andrew.
And Bob, I'd like to interject here. Jerome Powell in his speech said the Fed intends to allow some inflation, and he has no intention of seeing interest rates increase for at least the next 5 years. Is he just trying to give the illusion he's in control, because the long-term bonds have already gone up in price?
Yeah, the long yields are heading up, but you got to understand with these public officials, it's the public man speaking. And one of the best contrasts with that was when Alan Greenspan was central bank at the head of the Fed, and in 1966 he'd published stuff pointing out how valuable a gold standard was, that you needed it, and you needed discipline in central banking. And then when he became a central bank, he did what the position was required. They decided they needed easy money, and so I don't think there's ever been a time in history when the Fed was deliberately tight. And I'm going to add to that is that there have been conditions where credit disappears and it becomes very tight. But it's not Fed policy. As we note that the Barron's article in the early 1930s pointed out that the Fed was easy all the way through, and yet we went through that contraction. So I think the same thing is going to happen here. The contraction is going to overwhelm the central banks.
Good friend of the show, Mike Swanson, when I interviewed him earlier this week, said this whole push for low interest rates, he said, to quote him, is almost criminal because of the damage it does to pension funds, the insurance business, and banks.
Oh, yeah, it is, because normal instruments, credit instruments, and the insurance, casualty and life insurers really have all the actuarial stuff laid out in front of them, and they need to get certain returns. So then, and in most market cycles, you can get a reasonable return from reasonable risk. But what they've done is lowered rates so much that then many investors who should not be are reaching for risk to get a better return. And yeah, Jim, it is criminal, and it'd be a nice way if you could figure out some way of suing these guys or charging them or whatever. It's bad research, poor, shoddy research, wrong conclusions. And the whole thing about, let's do one more hammer on the Fed, and that was that when it was formed in the early 1900s, the establishment knew that if you had a financial crisis, it would be followed by a recession. I mean, that was the way it works. So then they came up with the idea of the Fed as the lender of last resort. Then you would not have a financial crisis. Then you would not have a recession. Now, Jim, this is still a very appealing theory. No recessions. But if you look at the National Bureau of Economic Research, they're the ones who officially decide whether it's a recession or not. There has been 19 recessions, including the current one, since the Fed opened its doors for business in January 1914. Obviously, the theory does not work, and yet these idiots are allowed to continue to practice unworkable theories. I mean, it is outrageous. We should go to another question. I'm getting too excited.
Yeah, well, and Bob, you've always pointed out we're now in our 19th recession. Yeah, so much for theories working.
Yeah.
Our next question comes from our good friend Henry Solomon in El Paso. And I remember the name from the Marty Robbins song. People, you want to look that up.
He did some good work.
The Dow he has some headlines for us for you to comment on. The Dow gets boost from banks as yields jump on Fed's inflation focus. Does this mean that the bond vigilantes are now in charge, or are real men going to short the long bond? Thank you.
Henry, that's a good one. There's been excesses at the long end of the bond market. And also, if you look at the 10 years in Germany, where they got to minus, my God, unprecedented. So the recklessness has been astonishing. But trends don't last forever. Trees don't grow to the sky. And somewhere this will change, and the surprise will be a contraction and the discovery that a lot of the debt can't be serviced, in which case prices go down, yields up, and then I haven't seen this bond vigilantes mentioned for a long time. I think I grabbed a cartoon on it some time ago. I'll see if I can find it. But yeah.
Wasn't that the name of a punk?
Bond vigilantes will be back.
Bob, I was going to say, it sounds like the name of a punk band in the 1970s, the Bond Vigilantes.
Spinal Tap. But then in the other one, Henry, are real men now going to short the long bond? Yeah, because the way the arithmetic works, as Henry knows, is the lower the coupon interest rate and the longer the term on the bond, the bigger the swings you get in the price on changes in interest rates. And this is where it goes back where, oh my God, decades ago, where in North America, bond trading desks, they scorned the Europeans because really they didn't go for anything beyond the 10-year. And that's where, gosh, it was years ago, decades ago, where they came out as real men trade the long bond, either long or short, and that's where character is earned. Thanks for the question, Henry.
We'll have more with Bob Hoye and more listener questions right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. Our listener, Kathleen, has a question for Bob here, and we have references to Ella Fitzgerald, Frank Sinatra, and, this will be interesting. Kathleen asks, Bob, this Fed-induced stock market mega bubble occurring in the middle of a severe financial contraction reminds me of that Johnny Mercer 1955 song, Something's Gotta Give. It was first performed by Fred Astaire in the film Daddy Longlegs and later by Ella Fitzgerald and Frank Sinatra. I realize that Chair Powell isn't Frank Sinatra or Fred Astaire. No doubt about that. But investors are still dancing and singing along to the sound of the Fed printing press and forward guidance. Bob, if something's gotta give in this inversely related stock market and Main Street economy, then what will that be?
Kathleen, I think that's one of our better questions, and if you're listening, I'm going to invite you to write a couple of paragraphs for us, and we'll publish them. Any theme you want. But at any rate, yeah, it's elusive. What you want to do is really look at, is the Fed credit expansion pushing prices up, or is it because there's speculators bidding prices up and employing credit leverage in order to accomplish this? Now, this gets kind of subtle, but as I said, in the 1970s, Fed ease went into bidding up wages, salaries, tangible assets, commodities, all that sort of stuff. And then reached a big peak in 1980. And then the commodity sector, the tangibles crashed real hard. And then the market shifted in 1982, discovered stocks and bonds, and the inflation in financial assets has been the dominant game since. So this is the subtlety, is that the Fed has one thing. It can ease credit. The public has two things. It can speculate in tangible assets, which it did, or it can speculate in financial assets, which it is doing. So the part about what something's got to give, yeah. And it'll probably be, well, actually it started last summer when the yield curve, short rates to long rates, inverted. And as we wrote at the time, I've got the yield curve charts back to 1857. And every inversion of the yield curve where short rates get higher than long rates has been followed by a recession. So that was a loud and clear signal from the credit markets last summer. And then actually, ironically, the way it worked out is early in the year, before the COVID flu thing hit, things were positive enough that the curve inverted again. So the last time you had the double inversion was in 2007, and unpleasant things happened. And then the time before, when you had, again, the two attempts at inversion, was in 1929, and very unpleasant things followed. And also with the 1873 bubble, where a Great Depression followed. So, the Fed has one tool. The public will choose to speculate in tangible assets, burnout, crash, then speculate in financial assets, bubble, crash, burnout, whatever you want to call it, and then you go into the credit contraction, the deflation, everything else like that. So this is a good question. It allowed me to almost do an editorial. And the gist of it is that credit does not push prices. Rising prices allows credit to expand, and then when prices come down, everybody gets hosed. So it's going to be a very interesting fall. We've got upside stuff on bond prices. It looks like we're going to talk about the 10-year yield, is starting to rise. It looks like it's technically making the turn to rising, and it's going to be a very interesting fall. Thanks for the question, Kathleen.
And another question. This one comes from Willem Grooters in the Netherlands. And by the way, folks, when you send your question in, we really like it when you include at least your country of origination or your hometown, because we have an international show, and it just lets people know that Bob knows his stuff, and we really welcome these questions. So Willem Grooters asks, does Mr. Hoye, and here you get the respect, does Mr. Hoye have a prediction for where the U.S. dollar-yen rate is going to go? Can we expect a similar scenario as in the second half of 2008 when this currency cross remained more or less flat? Whereas some people predict this cross will go down to the high 50s or low 60s. Does Mr. Hoye have an opinion on this topic?
Yeah, well, thanks for the question, and specifically to talk about the dollar-yen trade, I I don't follow it that closely, but I'm going to stick with when the next phase of the contraction comes in, then the U.S. dollar will rise relative to most currencies. And I think the reason for that is, and it's going to be ironical because a whole many pundits are all up on inflation. It's going to come back. Gold's going to go to 15,000, that sort of stuff. But what you have to look at is in the past, the Fed will not be allowed by market forces to depreciate the currency. And there are other market forces that maybe within that you should recognize, and that is that during the financial mania, where the stock market gets most of the attention, but you also have mania in the credit markets, and there's a huge amount of debt issued, which it has been. And then when that party stops, then debt issuers have a problem in servicing that debt. Now, the mechanics are that most of the debt is written in the world's financial center. It used to be London, now it's New York. And most of that debt will be contracted in U.S. dollars. So when the tide changes and all these reckless borrowers are now facing debt service problems, they have to service the debt in U.S. dollars into the financial center in New York City. So this then is, you can call it, the debt bubble is really a short on U.S. dollars. And so this is where you see every post-bubble contraction, the senior currency, it used to be sterling, now it's the dollar, becomes chronically firm against most other currencies and chronically firm against most commodities, and then I'll add in for most of the time. And that's how you end up with a post-bubble contraction or a post-bubble deflation. So, I think that the dollar eventually will firm up relative to the yen.
We'll have more from Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, a couple of headlines that you wanted to comment on. The first one, Fed easy money pumps up winners like Apple and housing. How's that going?
Oh, yeah. When the street picks big favorites like we've had recently with the FANG stocks, Apple and all these ones, it gets very compelling. And they get going. But again, you have to watch the technicals on it and the seasonals. And these now on some of these hot ones, Apple and are getting overdone. And with our work in March, we looked at the washout and noted that typical panics of that degree last for about 2 months, which took us to the end of March. So I think it was our March 19th piece was calling for a bottom. And then the seasonals are such that you'd have the rallies running into about mid-year. And it's within certain number of stocks, the big hot winners, it's continuing. But the broad market is no longer participating. And so the other part of this, our seasonal formula, was that after August, you then see things turning down. So, speculative spikes in August, it's there, measurable. And we're going into the season when liquidity problems can be discovered.
And finally, a headline that caught your eye as well. Running on empty. Emerging markets run through reserves due to virus.
Yeah, they're saying the virus, but I think the contraction would have started as the stock market turned down in January. And then what happened is the discovery of the virus made things a whole lot worse. I mean, in all of history, there's no governments have ever taken such drastic measures to actually halt an economy. So it's made things faster, worse. So again, it comes back to our work that when market forces turn adverse, it will overwhelm the urge for the central bankers to keep the party going. So,
Bob, thank you so much for answering all those listener questions.
Yeah, Jim, good to be with you, and look forward to next week. And look at this, like Roy Rogers, happy trails. No, this is happy trading.
If you have any questions for Bob, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.